Good afternoon. I hope people can hear me okay. Can you guys hear me? Okay, so we are trying to quote unquote upgrade the technology so that I don't have to have this. I found it personally a very unnatural tone of voice where I have this, yelling sound coming out of my mouth, and I really am not happy with that. And it's also it's tiring, but it's also not the way I like to teach. So we got a microphone and an additional microphone. So we're going to use that to make the class experience a bit better. All right, and I hope it works. I hope you guys can hear me fine. We did some testing, it should work. So, but at any point, if you can't hear me, please stop me, because again, this is a way for us to understand how to improve the class experience. All right, so having said that, I have folks that are joining as we speak, and here we go, which I am admitting right now. And here I am. So people that are remote can see me a little bit closer with this camera, and people that are in the room can actually see me as I am. So we're gonna, before getting started, sorry, we had the visit of IT. I just need to make sure that I'm cleared for today to be here. So please, you guys try to do the same, people in the classroom. And so what we're gonna be talking about today is, thank you, is we're going to be discussing a bit, just because we spent a few minutes to talk about this already in the other class of this morning. We're going to discuss that, soon we'll have our midterm exam number 1. Thank you. And as I had mentioned at the beginning of the semester, close to the midterm exams, you want to make sure that you look at the syllabus, because our class schedule gets slightly modified because of the midterm exam. So the midterm exam, it's longer than our class time. It's an hour and 10 minutes. And because of that, and given that this course is a coordinated course, what happens is that we have our midterm exam at the same time with everybody else. And so to also accommodate, what I mean by everybody else is everybody taking the AC 221 class. So different cohorts of AC 221. Because of that, and also to make sure that everybody takes the exam at the same time, what we do is to have the exam in the evening. So the exam should be between 7 and 8 p.m. It might be a little bit later than 8 p.m., but certainly the starting time will be 7 p.m. I will give you more details about logistics of the exam as we finalize them as a group. We had a coordinated call with all the faculty that is teaching AC 221 this morning, and we're going to sort of send you information next week at some point. Also, so when I talk about like class schedule, if you look at your syllabus, you'll notice that so the exam is Tuesday, October the 6th, and which is an off date for us. I mean, we typically have classes on Monday, Wednesday, Friday, and so the exam is on Tuesday. Therefore, in order to avoid to have 4 class meetings in a week, which is the class meeting of again, like a Monday, then Tuesday the exam, Wednesday the other class meeting, and Friday the last class meeting, which would be way too many class meetings. Then we don't see each other on Monday, so you guys have more time to study, and we see each other on Tuesday, and the Tuesday class will function as the first class meeting of the week. So you still have the same amount of class meetings, because typically we do exams during class meetings, but we don't meet on Monday, we'll meet on Tuesday, so for the exam, so that will be our class meeting, our first class meeting of the week. So we don't see each other on Monday, so just don't be surprised if you're not going to find me obviously connected at this time on Monday, October the 5th. And whereas you will be given information on how to connect on the exam on October the 6th. Any questions before I move on? Okay, so one more thing is the exam will be on Zoom, so you'll be given instructions to connect on Zoom. And the expectation is that you are connected with your video on Zoom for the whole time of the exam. As far as the practicing for the exam, we have posted like I posted the test, like the solution manual that is at the end of each and every chapter, like with the question that you have at the end of each and every chapter. The content of the exam is chapter 1 through chapter 5. And yeah, that's pretty much what I have to share right now. Obviously, the day of the exam, we are all remote. Nobody is in a classroom. And also given the time, obviously. All right, so we'll discuss more, like I said, but I just wanted you to remember about the October 6th at 7 p.m. date, and you'll certainly receive more information as we go. Any questions before we move on? No? Okay, so without further ado, I just realized that I had opened the screen, but then doing the IT technical means the screen got closed, so I'm gonna reload my slides and then we can get started. So today we're gonna be talking about accounts receivable. We'll touch upon cash. Frankly, the majority of what we do for cash is cash flow. So we're going to talk about cash extensively, but not right now. We'll do that later in the semester. So for today, I'm just going to give you sort of a sense of where like how to report the cash information. And other than that, we'll move on and talk about receivable and revenue. And again, the information that I am giving you is just on reporting rather than anything else. And also, before we get started, can you please unmute your video so that we are all at least virtually together. All right, so this is a roadmap that at this point you should be very familiar with. It gives us a sense of what are we doing, where do we stand in terms of sort of the big picture of the big AC 221 project. So what I mean by project is like the learning experience that we are having this semester. So we pretty much done like chapter 1, 2, and 3. And so we went through, the foundations of accounting. And what we're going to be focusing on next, which is, starting today, is revenue and cash and accounts receivable. And again, one thing, like I said, for cash, it's going to be a very small sort of introduction just about reporting. For accounts receivable, we'll talk about all the accounting around that. One thing that I would like to warn you on is accounts receivable as the difficulty of being one of those topics, and I think it's pretty unique in that sense, that it has a lot of different scenarios that can come to mind. You can, I'm hoping that the conversation would be as such that you may raise your hand and say, what about this scenario that we can have in accounts receivable? What about this? How do we account for that? And that's a healthy discussion. However, in class, we spend time just on the scenarios that are the most common. However, we have appendixes for all other scenarios that can present when it comes to accounts receivable. So just as an FYI. And the other thing is like accounts receivable has a lot of different transactions that you'll need to become familiar with. Also, how, like, so if we think about the balance sheet as the, as the left and the right side, so the left side being the assets and the right side being liabilities and equity, and how that relates to the income statement. The account that we're going to be talking about today are obviously cash and cash equivalents. Then we'll talk about sales and how sale may trigger accounts receivable. Notice the arrow goes that way because first I have a sale, and then depending on the collection terms of the sale, if it's on account or cash, I may or may not have a generation of an accounts receivable, like an account receivable being generated. On the other hand, what happens is, like, I have X amount of accounts receivable. Clients owe me as a whole $100,000. But, think about this pandemic situation. It could so well be that my clients do not have the means to pay me right now. And so what happens is that I have to book allowances for uncollectible accounts. Let's just say that I have $100,000 of accounts receivable. I estimate that 20,000 of that, like the 20%, it won't be collected. And so that will be the allowance, the estimate of how much I'm not going to collect, which will trigger an expense. So notice now the arrow goes the opposite direction. It goes from the uncollectible accounts receivable uncollectible account to the expense, because I first have to determine whether or not I have an estimate for uncollectible accounts, and from there, how much should be my expense. We're going to be focusing on this concept more towards the next few classes. So my accounts receivable minus the allowance of uncollectible accounts gives me the net accounts receivable. And you'll notice as we go through the financial statements that there are a lot of accounts that have the, well, we can see it actually. A lot of accounts that have the, okay, here you go. A lot of accounts that have the word net next to them. So typically, when you have the word net, that means that you either have a contra, so you have accounts receivable net, and then you have a property, plant, and equipment net, and then you have finance, a lease or right of use assets net, and then you have property under a capital lease or financing obligation net. When you find the word net, that means that there's either a contra account, in this case would be a contra asset account. So accounts receivable, that contra asset account will be the allowance for doubtful accounts, or property, plant, and equipment will be accumulated depreciation, or then you may have accounts that get reduced over time, and that's why you have, they have account like a, we're not going to discuss lease of right of use assets or property under capital leases, but those accounts get decreased over time as the time goes by. And so you have the net value there. But again, for our purposes, the reason why receivable is net is because it has a contra asset account, allowance for doubtful accounts, that reduces the value of the accounts receivable. So like I said, we'll focus on that later in the chapter, but that is definitely a good starting point that we need to think about. So cash and cash equivalents, it's, here's how we present it. And typically, the current assets are expected to be, the way we look at current assets is that we look at how they are expected to be liquidated. And so in the next 12 months. So I want to pause for a moment and talk about the way you learn and the way you learn for the exam. So typically for the exam, I would, like one thing that you need to learn is like the classification of the current assets and the current liabilities. And some people comes to this point, challenge the classification that I gave you. I believe it was last chapter, where I give you cash, accounts receivable, inventory, prepaid expenses, so on and so forth. And some people come back and say, that's not true. There are some companies who, like say Amazon, for example, Amazon has inventory right after cash. So that's not right, what you just taught us. Let's just say that both me and Amazon are correct, because in principle, there's not a scheme of, has to be cash, accounts receivable, inventory, prepaid expenses, and so on and so forth. In principle, the idea is that the current assets have to be represented based on the expectation of liquidation. So if for your company, the expectation of liquidation of the inventory is higher than the accounts receivable, and you can see why that's true for Amazon, then you shouldn't work, that's the way you should represent it, because that would give you a way of fairly representing the financial statements. And that's what ultimately we want to do here, because you want to show to the public that your inventory is more liquid than your accounts receivable. However, for the majority of the reason why I kind of gave you as a point of reference the cash, accounts receivable, inventory instead, it's because that's true for the majority of the company. So that's why I would like you to refer to that, unless you're told otherwise. All right, so cash and cash reporting, again, that's all I would have to say. I mean, we'll talk about just for a moment about what is cash. You have cash and cash equivalents, and basically cash equivalents could be demand of deposits, demand deposit checking accounts, saving accounts, time deposit, the ones that are within less than 3 months until maturity, certificate of deposits, high grade, like low risk US or government or foreign government securities. So those that pretty much appear to be very immediate, either actual cash or they can turn into cash very quickly, are considered cash and cash equivalent. Accounts receivable, on the other hand, and that's all I have for cash, guys. Accounts receivable, on the other hand, as we said, is represented as a net. What we're going to be spending time on is revenue recognition, sales return and allowance, and uncollectible receivable. So what is accounts receivable? Is the amount that a client, a company is owned by customers from prior revenue transaction. So I first make my sale, and then from there, I realize whether or not I'm going to have an accounts receivable, because if the client paid me in cash, I'm not going to have an accounts receivable. So because of that, before we talk about accounts receivable, we are going to talk about revenue recognition into the income statement. Because ultimately, I hope you would agree that you wouldn't have an accounts receivable unless you had a sale. So this is another way of looking at our roadmap here. It's a different version. Like that, the one that I showed you before is the roadmap of our course of AC 221. This tells you where are we in the financial statements. We have sales and revenue, and what we're going to find out is how they relate to accounts receivable. Here you see accounts receivable, comma, less allowance for uncollectible accounts. Sometimes you can see that represented as accounts receivable, comma, net. But that's what we're looking at into our financial statements. So revenue recognition, I mean, when we talk about revenue, at this point, it should be important for you to remember the revenue recognition principle, and also why we put that much emphasis on revenue. The reason why we put emphasis on revenue and net income also is because those are the indicators, the key performance indicators that investors look at when they have to make a decision. And also are the key performance indicators that shareholders look at, management looks at, because again, revenue give a sense of how much am I able to sell of my business, like not of my business, of what my business produces. And net income gives you a sense of how much value am I able to create by running my business. Remember, the net income will then, the value of the net income will then be transferred into retained earnings, which will then keep increasing the equity. So the retained earnings will show the value generated by the company. So that's why they're so important. But revenue recognition, as we have learned, it's basically the primary objective is like to make sure that we recognize revenue when they are earned. So here, I'm giving you a little bit of history, and I'm gonna put down this, the different bullets here for people that like to take notes, like me, for example, just because it gives you a little bit of a sense of what is the revenue recognition, the new pronouncement about revenue recognition about. So basically, beginning in 2018, publicly traded companies as early adopters had to adopt a new revenue recognition principle. And then in 2019, all other companies did. Why there was a need of a new revenue recognition principle? That's because FASB had recognized that over the years, there were new businesses coming up. And those businesses may not recognize revenue the same way like the traditional business did. New technology business came up. And so in this scenario, it was very difficult to also appeal for an auditor, but also for FASB to appeal to a company that had decided to recognize revenue in a certain way, which may have been more or less advantageous for the company and for the bottom line and for the compensation of the management. But just because there were no sets of rules that would address the new, how the new businesses, the evolving businesses had to account for revenue. So basically, FASB decided that they were going to put in place a few rules to make sure that it was clear, it was, very black and white how to recognize revenue. So let's assume, I'm going to make an example here. Let's assume that I am a new technology, a business that develops softwares for Verizon. I am, one of those software companies that develops the software of how Verizon is going to operate their towers, the towers for the signal of the wireless. So Verizon tells me, I want you to figure out how I can operate and remotely monitor those towers and the signal on those towers and do troubleshooting and all that kind of beautiful stuff. They're like, fine. How is the company that develops that software going to recognize revenue? Let's assume that Verizon told me to take care of that for 50 of their towers. And so how am I going to recognize the revenue? Am I going to wait until I'm done with all the 50 towers? Am I going to be implementing that software step by step? And if so, when am I going to recognize my revenue? When is that earning element coming up? So here's the way, just to streamline the process, FASB thought about it. First of all, you have to have a contract. So there's a contract, which is an agreement to whom you can refer to in case, to which you can refer to in case you have to, like you have a dispute or for guidance or reference point for your accounting of this contract. And so representation in the financial statement. Then you have to identify the separate performance obligations in the contract. That means, first and foremost, I'm going to be testing the existing technology on those towers. Then second, I'm going to go ahead and upgrade the software in 3 towers, which will be my pilot project. I'm making this up, guys. I'm just trying to give you a sense of like how things can happen and how that triggers, whether we like it or not, a question on how do I represent this faithfully and fairly in the financial statement so that external users can be informed. So let's say second, I'm going to test these 3 pilot towers. And then if that goes through and it goes well as a test, I'm going to implement it in the towers within a region, and then I'm going to move region by region. Fine. When did I earn my revenue? Well, when those performance obligations have been realized. But how much am I entitled to have recognized, to be paid for those performance obligations? The FASB tells you, you got to attach a price to each and every performance obligation. At the first step, at testing of of the performance technology, I'm entitled to $10,000. If that's the case, then what happens is that, again, like you have to recognize the revenue only after the company is satisfied with your work. Because remember, this is the most important step, number 5, because unless the client is not satisfied, the rationale is that you haven't earned your revenue. And remember, in order to recognize revenue, we have to earn them. If Verizon says you've done an awful job at testing this software, what have you done? You haven't even showed up at the towers. What are you talking about? Then you didn't earn it. So that's why, like I said, number 5 is the most relevant. This is very important, guys, because if you take the time or like willingness of looking at financial statements of previous years, you'll notice that there were sort of adjustments to account for the revenue recognition principle and throughout all the financial statements. This was a big thing that happened over years and years of discussion. All right. So how, let's talk about revenue then. How do we make, and the idea is that, as I said, revenue are the most, if you will, important measure of and point of reference for investors along with the income statement. So obviously I want to maximize my revenue. So how do I make it more appealing for customer to buy my products? One idea would be to give discounts, to give the right of return, or in sell on credit, meaning like you don't have to pay me right away. You can pay me as, within a certain period of time that is indicated into the invoice. I can give you a discount, and I can give you obviously the right of return. So you can buy my products. If you don't like them, you can bring it back. What happens if the customer don't pay? What happens if you give them all these beautiful options and still they don't pay? In a situation, for example, like COVID-19, companies have been and will be on for the foreseeable future monitoring what happens if the customer doesn't pay. So monitoring the uncollectible account expenses, the bad debts. So it's kind of interesting because what we all think in English, it can be translated into something that we can represent into the financial statements, which is in this case, the uncollectible account expense. So that's what we're going to be talking about today. So let's start with trade discounts. Trade discount is very straightforward. I mean, like you have a customer who purchases a lot from you, and as a sort of to acknowledge the long-lasting relationship with the customer, you may give the customer a trade discount. Like BU right now is getting probably a custom, I don't know, I'm making this up. Let's assume that BU right now gets a big discount because has this little kiosk with wipes in classrooms everywhere. So I would assume that somebody at BU might have tried to ask for a discount for those supplies. Whether we got it or not, it's a different story. But again, typically the trade discounts are given to businesses, not individuals. But again, it's typical, not necessarily the absolute truth. So how do we account for trade discounts? The trade discount is really like a reduction of the gross selling price, which I keep it as is in the financial statements. And I'm going to ask you in a moment, why do you think that is? But let's just say that the idea is that, I'm sorry, that's not true. That's more for returns. For the trade discounts, what we do instead is basically you can have it as a gross, keeping the gross selling price and the trade discount separate. But what I'm showing to you today is the most straightforward, which is just use the net price. Because the one that keeps the gross and the net, it might be, and the discount, it might be a little bit too cumbersome. So for today, we're going to be looking just at gross selling price of 1,000 less 5% discount. Let's assume that I have a net price of 950. That's how I would record my sale. I will have an increase of cash of 950 and an increase of sales of 950. The discount is embedded into the sales price, the sales amount that I have booked. You can have it also gross, but again, we are not going to be discussing that today. However, I will still ask you for the returns why we keep it gross, but that's next to come. Any questions about this in particular? It should be pretty straightforward. I mean, I sell goods for $1,000, less a 5% discount, then I'm going to get paid $950, and my sales will be $950. Any questions? No? All right, returns. We all have experienced that in life. But unless you tell me otherwise, I would think none of us has ever thought, how does the company to which I return the merchandise treats my return from an accounting standpoint, hence reflect that into the financial statements? I don't think any of us in their wildest imagination has ever even asked that kind of question. When you have a return, it's because you're unhappy and you look like this. You really don't worry and don't care about what the company is going to do in their financial statements with your return. However, that's what we're going to be talking about today, because we also have to give information about our returns to the public through the financial statements. So we're going to be talking about sales return and allowance. So customers may be unhappy about a product, or they might not need it anymore. They're like, you know what, I thought I would need a new sweatshirt because it's kind of cold outside, and then a day like this happens and you're like, maybe not, I'll hold on to it. Because I don't know about you guys, where you guys are located, but in Boston today is a gorgeous day, sunny, warm, fantastic, perfect Friday, I would say. So seller might be unsatisfied by and basically seller may help, unsatisfied customers by either allowing them to return the merchandise or granting them a sales allowance. What does that mean? Sales allowance obviously is a price reduction. Let's assume true story, I bought a rowing machine, and I got the rowing machine, which obviously, as you can imagine, is huge. And there was a piece of anyway, like a piece that attached to the base of the rowing machine, that it wasn't really doing its job, and so it wasn't attaching the rowing machine to the base. So I called up the manufacturer, and they said, "What do you want to do? We can send you back a new of this piece, so you can replace it on your own. It was really easy to assemble, or you can return the whole machine." I mean, I don't know about you guys, but I don't have typically the capacity of returning a rowing machine. Just humanly, I couldn't even think about it during the pandemic. So what I decided to do, I said, I'll keep it, ship me that piece, but because for the inconvenience, I would like a reduction of the price. And so they, credit my credit card by X amount of dollars as a sales allowance. I'm sure, like, we have all experienced some stuff like that. You get a half defective a product that still can work, and you get it to a lower price. You get a price reduction. So that's what we mean by sales return and allowances. Why am I being so specific? Because for any reason in the world, I want you to confuse the sales allowances with the allowance for doubtful account or uncollectible accounts that we're going to be talking about over the next few classes. I know the semantic might be tricky, but are totally different concepts. The reason why I'm saying that is because that's what I get all the time. It's like, but how does sales allowance fits into this? It doesn't. They're two different concepts. One is sales allowance, one is the allowance for doubtful accounts. So how should we record return transactions? So typically it's a step-by-step. So if I have a return, guys, if I'm a company, let's just think about the rowing machine company. Let's assume it wasn't a Technogym rowing machine. I personally cannot afford that kind of stuff for my house. But let's assume it was a Technogym. So Technogym now is dealing with, and let's assume I chose instead of returning that rowing machine. What happens is that, I don't know how much a rowing machine for Technogym might cost. Let's assume $3,000. Well, they don't have that. Technogym has to reduce their sales by $3,000 because they no longer make that sale. So I would reduce that by net sales by using like a contra revenue account for the return. Then I will record like what things basically happen is that if I hadn't returned it, but if Technogym, on the other hand, wants to estimate the returns and says, you know what, typically what happens is that I sell, I don't know, 100 rowing machines a month, and of that 100 rowing machines, regardless of what I did, of those rowing machines, typically 20% come back. So it's like a new piece of information, I suppose, for you guys, where you get to know the fact that companies typically estimate that a part of their sales will be returned. It's part of their financial statements. So what happens is so in that case where I'm expecting returns as a company, what happens is I'm going to reduce the net sales by the expectation of the sales that will be either returned or from which I'm going to give a sales allowance. I will record the liability for the sale value to show the obligation that at some point, if somebody returns the merchandise to me, I have to pay them back. So I may have a prospective obligation. So I book a reserve. That's the accrued liability pretty much. Based on previous years or previous period historical data that tells me of every 100 that I get on average 20% returns for my rowing machines, which would be pretty high, but we're just making the hypothesis here, or like the example rather. So again, I would reduce sales. I would create a liability for the expected amount that I have to give back to clients for sales that have been returned. I will increase the inventory for the expected amount that will be given back to me, for the expected amount of goods that will be given back to me. And then I'll reduce the cost of goods sold. Why? Remember, if I didn't make the sale, my cost of goods sold would be, I wouldn't have the cost of goods sold, because if I didn't make the sale, my inventory will still be in my warehouse, it wouldn't be sold. So I will need to adjust the cost of goods sold too. Why do I do that? Matching principle. All the costs or the expenses have to be associated with the revenue. If I carve out the revenue, I have to carve out the costs associated with it. Does it make sense? Yes, no, maybe so. Okay. So let's just look at this example. And this example, we're gonna read it like a little bit at a time because it's a long example. So we're gonna start with Red Terrier has $100,000 cash, $100,000 sales for cash. The cost of the inventory sold is $50,000, and I'm gonna stop right here. So how do I book that sale, guys? What do I do? I mean, this is something you guys should know by now.
Debit cash.
Anybody?
Okay.
I'm sorry, Christina, could you please repeat that?
Yeah, debit cash for 100K.
Yeah. So you have a cash increase, you collect the cash, and what else happens?
Do your retained earnings go down?
My retained earnings will go down. Why?
Would your revenue go up?
So in Classroom, would the revenue go up? Yes. So,
Oh, yeah.
So my sale will be that my cash will increase and my revenue will go up. So Vanessa, like the effect of the sale going up will increase the retained earnings when I do my closing and stuff. Am I done? So I suppose I took care of this first part over here, that Red Terrier has $100,000 of sales for cash. So this transaction takes care of that. And then it says cost of inventory sold is 50,000. How do I book that part? Yes, go ahead.
Debit the expenses, you credit the inventory.
Yes. So so in class we are saying debit the expenses and credit the inventory. What particular expense we're gonna be increasing by debit? People on Zoom, possibly. Brooke?
Maybe the cost of goods sold would be.
Yes.
Debited?
So cost of goods sold,
debited.
that's exactly right. Cost of goods sold will be debited. And so Vanessa, you mentioned a reduction of the retained earnings. As a consequence, my return earnings will be reduced. And cost of goods sold will be debited. So cost of goods sold increases and inventory decreases because I am selling the merchandise. So that is pretty much everything up to this point over here, guys. Up to here, okay? So now we're gonna go in the next slide and we're gonna look at the next step in this equation, in this transaction. So no prior allowance for return was recorded. So this is the first year, let's assume it's the first year of operations. Based on historical experience, RET estimated that 20% of the items it sells eventually are returned. So, and we're going to stop here. So now we have to think about how to account for the expected return. Remember, we said we'll reduce the revenue. So that's how we will do it. We will reduce the revenue by using a contra asset account called sales return and allowances. And we'll book a liability called sales refund payable, which shows the obligation that I have to pay for expected returns. And how much is that? 20,000. Then we'll talk about the reduction of the inventory. I'm sorry, not the reduction, the sort of accounting for the inventory returns estimated, which would be an increase of inventory overall, but that amount, inventory returns estimated, will be a completely separate account. And why that is $10,000, guys? It says 20% of 50,000. Why do I calculate it like that? James? Is that you?
Yes.
I'm sorry. Why do I have two? I'm so sorry. Oh, because you have this one and that. Oh, you are connected to, got you. Anybody else? I don't know. Manab, why do I have, why it's 20% times 50? What is the 50?
50 is the cost of inventory sold.
50 is the cost of the inventory sold. So the expectation is that if I am going to get returned if I'm going to have a return of 20%, then I will get 20% physical of inventory back. So, and I correspondingly reduce the cost of goods sold. I kind of reverse the entry. So again, I book a sales return and allowance, which will reduce the revenue. I'll have revenue of 100,000, and that sales return and allowance, which is a contra revenue account, will reduce my revenue to 80,000. So my net revenue will be 80,000 now. Then I will build a liability, which it shows the expectation of returns and my obligation to pay for those returns. And I will build an account of inventory returns estimated, which basically is shows me what is the amount of inventories that I am expecting to have returned, as well as like what is the reduction of cost of goods sold. So having said that, the last thing that I would like to do with you guys is look at the last piece of this transaction, which is later. Sorry guys, here you go. So later in the current period, the 10,000 of sales were returned to RET. The remaining returns are expected in the following period. How do you do it? So you have impacted your income statement already. You reduce the revenue. You reduce the cost of goods sold. Now you can deal with this just at the balance sheet level. You took care of it from a cutoff standpoint. You booked the expectation in the year or the period where you made the sale. So you matched all the sales with all the costs associated with that sale, including the one of the return. So what happens? At that point, you're just gonna have like sales refund payable, 10,000. So you reduce that liability of 20,000 by 10,000. So now your obligation to pay for returns in the future is the remainder $10,000. You'll have a reduction of cash because you're giving money back. Your inventory, your actual inventory increases by those returns if they're not damaged goods. And your inventory returns estimates decrease because you had estimated 10,000 worth of inventory returns. And so far you got 5,000 inventory returns back. So inventory returns estimated is an adjunct account, meaning that you pretty much add together inventory and inventory returns estimated to get to the inventory value at the end of a period. So again, you book a liability, you reduce revenue for the expected amount of returns. You book a liability for the obligation of how much you're going to be paying the clients in case of returns. You increase the inventory by increasing the inventory returns estimated account by the amount that it's related to the cost of goods sold of the sales you made, and you reduce of the same amount the cost of goods sold. At the time you have a return, as opposed to use any income statement accounts, at that point you don't use any income statement accounts, you use just balance sheet accounts, so you don't touch the net income anymore. You reduce your liability because you're paying that liability, you reduce cash, increase the actual inventory for the amount of the return, and reduce the estimated return of inventory. So it is a lot, and people typically at this time ask me, how about, and this is really a lot, and it's it for today, but one thing that typically people ask me and linger and wonder is like, what do I do with that remainder of refund? What if I never got that 20% of returns? What if I don't get that amount of returns? Well, the sales return allowance, the sales refund payable account gets replenished as you need it. Say you have $3,000 $10,000 at the beginning of the following period, and then based on your volume of sales, you realize you would need a sales refund payable at a level of 15,000. You're just going to increase it by the 5,000, so you'll replenish it by 5,000. So that's how it works, and that's how what we're going to talk about next week. But again, I just didn't want you wonder what do I do with the remainder. You just measure it and replenish it if needed. With that being said, I hope you guys have a great weekend. I hope you guys enjoy this beautiful day, and for those of you who are in Boston, for other folks, I hope you have a nice weather wherever you are. And we'll see you on Monday. Thank you. Bye.
Thank you.
I have a very quick question.
Sure.
Why on the last slide, why did we do for inventory, why did we do it times 0.5? Where did the 0.5 come from again?
Sure. It's basically, let me show you again the slide. So here, the 0.5, Vanessa, is basically you had a cost of goods sold that was hold on, let's go back. If you look at the ratio here, I'm not sure why the slide shows like this, but never mind. If you look at the ratio here, you see that the sales are 50% of the cost of, I'm sorry, the cost of goods sold is 50% of the sales, right? And so basically my inventory will be, inventory will be increased by the 50% of the value of the refund, because my cost of goods sold and the value of my inventory is 50% of the value of the sales. So that 0.5 is your 50%.
Okay, awesome. Thank you so much.
No, thank you. Bye.
Bye.
Bye, guys. Alrighty. It's nice to preserve your earring.
Yeah.
I couldn't take it anymore, let me tell you.
Did they fix the audio or something?
They give me that.
Oh, nice.